Let's build on our framework further by studying liquidity management in more depth, since this is essential to understanding how the monetary policy works. The current banking system in the US has evolved a long way from the 1920s and the 1930s. In the 1920s, large profits were made by banks by mixing the traditional business of banking, of accepting deposits and sanctioning loans, to underwriting securities, trading commodities, investing in capital markets. So there was a mix of commercial banking and investment banking. This period saw an emergence of a new type of banking that combined commercial banking with investment banking business. Asset liability management was proving to be a nightmare. From the collapse of the financial system in the US, the crash of the 1929 and the Great Depression that followed, strong regulations on banking emerged. The most famous one was the Glass-Steagall Act of 1933 that basically segmented commercial banking activity and investment banking activity. The act imposed interest rate caps on deposits, and the Section 11 of the act further restricted any interest payment on demand deposits. The Fed also had authority to regulate time deposits under Regulation Q, also called the Reg Q. These regulations spawned many innovations in the financial market that make an interesting read. However, for our purpose, we will only look at what is relevant to the monetary policy. Let's revisit the asset liability management theory to understand how central banks influence the banking sector in the current day scenario. So with the growth of the industrial sector over the years, the banking assets grew steadily to include mortgage lending, consumer lending, lending to different industries, and interbank lending. Banks also invest in securities and place cash reserves with the central bank. Due to this increased scope of lending, the requirement for funds increased. Banks needed to come up with innovative sources of funds to circumvent the banking regulations placed on the terms of the usual liabilities such as deposits. We have already discussed checking and time deposits earlier. In many countries, small local banks were good in mobilizing deposits, but poor in getting good loan opportunities as compared to their city counterparts. An interbank deposit was a good way for local banks to earn on surplus funds and was a good source of funds for the larger banks. So let's discuss a few banking innovations used by financial intermediaries to manage their assets and liabilities.